Mutual funds collect money from different people and invest this money into certain blue chip companies, such as all of these. So in short, all the safe, reliable companies which we know have a lower chances of going bankrupt. Now, whatever profit they'll receive, they'll distribute this amount back to the investors. But they'll also keep some money for themselves because they are not running a charity. This money that they keep to themselves is called as the expense ratio. So, how does that affect your money? Let's see.
Now for your money, say if I invest rupees 2000 for 10 years with an interest rate of 12%, I will get this amount. Now if I copy this and paste it over to my Google Sheets and edit it as well, you can see the invested, profit and total amount. Now if we add another column over here called as the expense ratio. Now this expense ratio is usually between 1 to 3%. Let me mark it as red because it's going to be deducted. So let's just take 3% for this example. Now we get another column because of the expense ratio called as the deducted amount. Now to calculate this deducted amount, we multiply our total amount with the expense ratio. Now this 13,940 is the amount which will be subtracted from your total amount. So your real total amount becomes the OG total amount minus the deducted amount. Hence, instead of ending up with 4,64,000, you end up with 4,50,000 because of the amount you lose to the expense ratio.
This is exactly why knowing the right type of mutual fund becomes important. Hello and welcome to another video by Alice Blue. Here, we make everything related to investing, trading and personal finance one step deeper and one level easier. As per SEBI's official classification, we have 5 types of mutual funds: equity, debt, hybrid, solution-oriented and other mutual funds. This category is based on the investment objective. Investment objective as in why does this mutual fund exist and what does it try to do with my money. So, from an investment objective point of view, equity mutual funds is for capital growth or money increment in the long term, which is usually over 5 years. Now this one is suitable for investors looking for higher returns but with a higher risk appetite. They have the highest expense ratio ranging from 1% to 2.5% as the fund managers picking and managing stocks takes time, effort and cost. Here are some of the small, mid and large cap equity fund examples. I'll leave the link in the description down below. You can go and check these out. Debt mutual funds are for generating stable and regular income by investing in bonds and treasury bills. They usually involve lower risks and lower expense ratios, usually between 0.1% to 1%, because managing bonds and treasury bills is simpler and it's less volatile. However, the time span tends to be smaller, lasting from 6 months to 3 years. Hence, it is suitable for anyone looking to park their surplus funds safely for a short while. Here's the list of the debt mutual funds you can find in India. Hybrid mutual funds offer a balance of growth and income by investing in both equity and debt funds. So this is basically trying to combine the best of both worlds. The higher returns from equity combined with the lower risks of debt. The expense ratio can range anywhere from 0.8% to 2% because of the dual asset management. Hence, this one is best suited to achieve a medium-term goal between 3 to 5 years, or say maybe buying a car or funding a vacation. Here's the list of the hybrid mutual funds you can find in India. Solution-oriented mutual funds are for achieving a specific life goal, like if you're planning for your retirement or your child's education or their marriage in the future, obviously. This is essentially one of the set and forget kind of investments. So its time period can be 10, 15 or can even cross over 20 years. Although keep in mind that these have a lock-in period of usually 5 years and these are not risk-free, but due to the longer time period, it can balance out the risks. The expense ratio here are moderate, between 1% to 2.5%. Now, this is because these are specific goals. Hence, they need a specific strategy which ensures that these goals are met. Now, here's a list of the retirement solution oriented plans you can find in India. Other mutual funds include index funds, exchange traded funds or ETFs, and fund of funds or FOFs. So, we have this Nifty 50 and the BSE 100, right? Now, these highlight the top 50 and the top 100 companies within the Indian stock market. Now, index mutual funds like Nippon India Nifty 50 Index Fund mirror this. So, if the Nifty 50 goes up by 5%, this index fund will also go up by 5%. And if Nifty drops, the index fund drops too, like a mirror. ETFs are also similar to that, except you can trade them during market hours, like how you can just buy stocks of Reliance or TCS, similar to that. So it's a mixture between a mutual fund and a stock. FOFs can put your money anywhere: index fund, debt fund, ETFs, or even international funds. Now, index and ETFs have lower expense ratios between 0.05% to 0.5%. FOFs are higher, between 1% to 2.5%, because you pay for two layers: the fund and the underlying funds. You can check out index, ETF, and FOF funds from these pages. I hope now you have a better understanding regarding the different types of mutual funds and the underlying costs associated with each one of these. Before investing in mutual funds, make sure that you're well acquainted with the risks involved in all of these as well. To learn more about that, check out this video. And I'll see you guys next time.
Investments in securities markets are subject to market risks. Read all the related documents carefully before investing.